Navitas Semiconductor is currently trading at $15.77 per share, showing a slight intraday dip of 0.13% as of this Monday morning, May 11, 2026. While that tiny decimal point of movement might look like a quiet start to the week, it actually masks a massive amount of tension sitting just beneath the surface of the ticker. If you have been tracking the chip sector lately, you know that the expectation for almost anything with the word semiconductor attached to it has been absolute vertical moonshots. People look at the charts for Nvidia stock or the high-flying excitement around anything AI related and assume that every component maker is printing money. But the reality for Navitas is much more of a high-stakes balancing act than the headlines suggest. We are looking at a company that is essentially trying to rebuild its entire engine while flying the plane at 30,000 feet. The insight most people are missing right now is the sheer speed of their strategic pivot. Just a few quarters ago, Navitas was heavily leaned into the mobile and consumer electronics space. Think smartphone chargers and laptop bricks. That was a fine business, but it was low margin and tied to the cyclical nature of phone releases. Today, they are aggressively shedding that skin to become a high-power infrastructure play. While the general market narrative is that Navitas is just another AI play, the reality is that they are currently sacrificing their old revenue base to chase a much more difficult, much more lucrative piece of the pie in data centers and industrial electrification. It is a bold move that has institutional investors leaning in, but it creates a massive gap between the story they are telling and the numbers on the actual balance sheet. When you look at the recent trading activity, the volume has been sitting around 34.94 million shares, which is actually a step up from their usual average. This tells us that the smart money is actively repositioning. We saw a massive 12% surge just a few sessions ago, and that wasn't just retail hype. The options market is currently flashing some very interesting signals. We're seeing a put-call ratio of about 0.25, which is way lower than the typical 0.46 we see for a stock in this volatility bracket. In plain English, the traders who put real capital on the line are heavily favoring upside bets. They are anticipating that the pivot to Navitas 2.0 is going to catch fire. But here is the friction. While the stock has been a monster performer over the last few months, rising over 100% since the start of the year, the revenue is actually down about 45% compared to the previous year. That is a massive disconnect. It creates a situation where there is zero margin for error. If they miss a single beat on their high-power rollout, that 74x sales multiple could deflate faster than a punctured tire. The common ground for most investors using investing sites or looking for investment help is the belief that GaN and CIC technology, gallium nitride and silicon carbide, are the inevitable successors to old-school silicon, and they are right. Silicon is hitting a physical wall. It gets too hot and wastes too much energy. Navitas makes the chips that solve that. But the contrarian take you need to consider is that being right about the technology doesn't always mean the stock is a safe bet today. We are seeing massive competition from entrenched giants like STMicroelectronics and Infineon. These guys have deep pockets and existing relationships with every major car and server manufacturer on the planet. Navitas is the scrappy innovator, but they are fighting for space in a market that is becoming increasingly commoditized. If you're looking at your individual brokerage account today, you have to ask yourself if you are buying the technology or the execution. In the first quarter of 2026, Navitas reported revenue of $8.6 million. That was an 18% sequential increase, which is great, but it's still a small number for a company with a $4 billion market cap. They are essentially a promise stock right now. They have a design win pipeline worth over $2.4 billion, but a pipeline isn't a check in the bank. It's a list of potential orders. The real story of the next few months will be how much of that pipeline they can actually convert into realized sales before their cash pile starts to look thin. They ended the last quarter with about $221 million in cash, which gives them a decent runway, but their burn rate is still significant because they are spending so much on R&D to stay ahead of the bigger players. Let's talk about what they actually do for a second, because understanding the why behind the tech is the only way to understand the if behind the stock. Their GaNFast and GeneSiC products are designed to be digital in, power out building blocks. In an AI data center, power density is everything. If you can make a power supply 40% more efficient, you aren't just saving on the electric bill, you are allowing the data center to pack more GPUs into the same rack without melting the hardware. This is why Navitas was showing off their new 20 kilowatt power delivery boards at the Nvidia GTC conference. They are positioning themselves as the efficiency layer for the AI build-out. It's a compelling pitch, and it's why analysts from places like Morgan Stanley have been nudging their price targets upward, even while warning that the stock is getting a bit ahead of itself. The sector momentum is also working in their favor. We're seeing a massive shift towards intelligent portfolios and self-investing strategies that favor these second-order AI beneficiaries. People are tired of chasing the trillion-dollar caps and are looking for the next layer down. Navitas fits that profile perfectly. However, the macroeconomic pressure is the elephant in the room. High interest rates have made it expensive for industrial companies to upgrade their infrastructure. If the global economy cools down and data center operators decide to stretch their existing hardware for another year, the Navitas 2.0 timeline gets pushed back. And as we discussed, with a valuation this stretched, time is the one thing this stock doesn't have a lot of.
Think about how you are managing your own portfolio for a moment. Are you leaning toward the big stable names or looking for these high-growth pivots? Comment below how many shares of Navitas Semiconductor you currently hold, or if you are waiting for a deeper pullback before starting a position. It is always interesting to see how many people are actually willing to ride the volatility on these mid-cap tech plays versus sticking to the blue chips. Looking at the future outlook, the catalysts for the rest of 2026 are very clear. We need to see that sequential growth continue. Management has promised that the high-power markets will represent an even larger majority of the revenue as we move into the second half of the year. If that happens, and if they can start showing a path towards narrowing their operating loss, which was nearly $28 million last quarter, the market will likely continue to reward them with a high multiple. But if that $8.6 million revenue figure stays flat while the losses continue to widen, the narrative of a successful pivot will start to crack. There is also the risk of competitive displacement. In the world of power semiconductors, you aren't just competing on who has the coolest lab result, you are competing on who can manufacture 10 million units with zero defects at the lowest price point. Navitas has a great manufacturing partner in GlobalFoundries, which helps with their Made in America narrative, but they are still the small fish in a very big pond. The structural risk here is that a company like Texas Instruments or onsemi could come in with a good enough solution at a much lower price point and squeeze Navitas out of those big data center contracts. When you step back and look at the whole picture, the expectation is that Navitas is a rocket ship fueled by the AI boom. The reality is that it's a high-precision instrument being rebuilt mid-flight. It's incredibly innovative and perfectly positioned for where the world is going, but the current stock price is asking you to pay for the year 2030 today. For some investors, that's a risk worth taking. For others, the disconnect between the negative 195% operating margin and the soaring stock price is a red flag that can't be ignored. Whether you are using Fidelity, Robinhood, SoFi, or Interactive Brokers to manage your trades, you have to be honest about what kind of volatility you can stomach. This isn't a set-it-and-forget-it index fund. This is a battleground stock where the story and the math are constantly at odds. Navitas is successfully moving away from the low-margin world of phone chargers and into the high-stakes world of AI power, but that transition is expensive and far from guaranteed. In summary, we have a company that is technically brilliant but financially fragile. The live price of $15.77 reflects a market that is willing to believe in the future, even if the present looks a bit messy. The shift to high-power markets is the right move, and the early data suggests it's starting to work, but the competition is fierce and the valuation leaves no room for mistakes. Expectations say this is the next great component play. Reality says it's an ambitious turnaround that still has everything to prove. Keep a very close eye on the next earnings report, because that is where the promise of the pipeline will either turn into the reality of revenue or become a cautionary tale of a stock that flew too close to the sun. It is a fascinating case study in how the market values potential over performance, and for now, the believers are still in control of the tape. Stay sharp, stay informed, and always make sure you're looking at the numbers behind the narrative. The semiconductor space doesn't forgive those who ignore the friction between the hype and the hard data. Disclaimer. This video is for educational purposes only, not financial advice. Please do your own research before investing. Market involves risk. Like this video, comment your thoughts, unshare with your friends, bell subscribe for more updates.